Hey everyone, a lot of traders often get lost in the clutter of price charts and the absence of a clear trading strategy. That's exactly why in this video, we're going to break down 3 powerful smart money trading setups with step-by-step mechanical rules, eliminating all the guesswork. These methods integrate essential elements from smart money and price action, such as market structure, fair value gaps, liquidity grabs, equal highs and lows, and trading psychology. So traders, if you find this helpful, hit that like button to support the channel, and if you're new here, don't forget to subscribe. I'll catch you right after the intro and the disclaimer. Let's dive right in. As mentioned earlier, these strategies revolve around market structure, fair value gaps, liquidity grabs, equal highs and lows, and multi-time frame analysis. But here's the exciting part. We won't be manually drawing these levels on the chart. Instead, we'll leverage the price action toolkit indicator to automatically pinpoint them for us. So, let's not waste any more time and jump into the first setup. In this trading strategy, we operate using 2 time frames. On the higher time frame, we assess the market structure to identify the trend direction and align our trades with it. This involves spotting structure breaks and character shifts. Then we map out the fair value gaps, which act as our prime trade zones. After that, we switch to the lower time frame to locate our entry signal, usually in the form of a liquidity grab. Once identified, we take the trade and set our targets accordingly. Now, why is this method effective? By merging these 3 principles, you ensure alignment with the trend, entry from key supply and demand zones, and added confidence through lower time frame confirmations. So, let me walk you through how this plays out on a price chart. As I mentioned earlier, we'll be using the price action toolkit to automatically plot all these concepts. Let's begin by activating this tool. Head over to the Indicators tab, type in Price Action Toolkit, and select the version provided by Flux Charts. Once added, open the Settings menu, and you'll see a variety of options you can enable on the chart. For this example, we'll start by enabling the BOS, CHOCH, and CHOCH Plus labels under the Market Structure section. These are the fundamental building blocks of the market structure model. Here's a simple diagram that outlines how the indicator displays market structure labels. The BOS tag stands for break of structure, which occurs when price moves beyond recent highs or lows. A bullish BOS indicates upward momentum and suggests a likely continuation in that direction. Conversely, a bearish BOS shows downward momentum, hinting at a possible continuation to the downside. Now let's look at the change of character, or CHOCH, labels. A typical bullish CHOCH takes place when the price first breaks a recent low, creating a bearish BOS, then quickly breaks the swing high that led to it. This sequence forms a standard CHOCH and may point to a bullish reversal. In the same way, a bearish CHOCH appears when the price first breaches a recent high, forming a bullish BOS, then breaks the swing low responsible for that move. This may signal a bearish reversal. But here's where the price action toolkit goes a step further. It can also detect when the market forms a lower high before breaking a bullish structure. This is shown as CHOCH+, which represents a stronger and more reliable shift in character, potentially offering a higher quality reversal signal. Up next, we have fair value gaps. By enabling this feature in the indicator settings, these gaps will be automatically displayed on your chart. Fair value gaps show price imbalances, areas where there's a noticeable gap between the market's perceived fair value. Within the settings panel, increasing the sensitivity filters out the smaller gaps, allowing only the significant ones to be shown. There's a greater likelihood that price will revisit these zones to restore balance, making them prime areas for potential price reactions. We'll treat these gaps as high-interest zones where market activity is expected. Now let's move on to liquidity grabs. Once activated, you'll notice green and red circles appearing on the chart. These indicate bullish and bearish liquidity grabs, respectively. When the price spikes above a prior swing high, the tool flags it as a bearish liquidity grab, suggesting a potential move to the downside. Likewise, if price dips below a previous swing low, it's labeled a bullish liquidity grab, hinting at a likely reversal to the upside. Liquidity grabs mark zones where the market takes out stop losses before reversing, and they serve as excellent entry signals when paired with other concepts. Lowering the pivot length and wick to body ratio increases the indicator's sensitivity, allowing it to detect more of these grabs, capturing smaller wicks and a broader range of price action that could imply liquidity being absorbed. Now, let me demonstrate how this trading strategy plays out on the chart. This method relies on analyzing two time frames. We recommend using the 1 hour for analysis and the 5-minute for entries, although other combinations work too. Just ensure your entry time frame is at least half the duration of your analysis time frame. Starting with the higher time frame, the first step is determining the market's direction. You can do this by analyzing key market structure concepts. For instance, if the price consistently forms higher highs and higher lows while breaking previous structure points, that confirms a bullish trend. We consider this bullish until a change of character is observed. Once the trend is established, the next task is identifying fair value gap zones. On the higher time frame, these gaps carry more weight and often serve as strong support or resistance areas. After locating these gaps, wait for the price to retrace into one. Once it enters that zone, drop down to the lower time frame to find your trade setup. At this point, you're looking for signs of a potential reversal. A strong clue is a bullish liquidity grab, where price dips beneath a recent low, triggers stop losses, and quickly bounces back. If that movement also breaks a nearby bearish structure on the lower time frame, it serves as added confirmation. In essence, that's a change of character. Now it's time to take the trade. Set your stop loss just below the low of the liquidity grab, and aim for the next significant level visible on the higher time frame. For bearish trades, begin by confirming a downtrend on the higher time frame, identified by lower highs and lower lows. Mark the fair value gaps as potential supply zones. When the price revisits one of these zones, move to the lower time frame and look for a bearish liquidity grab above a recent high. Once confirmed, take the trade. Place your stop loss just above the liquidity grab, and target the next important level below. That said, always follow sound risk management to preserve your capital. Stick to your strategy and avoid letting emotions drive decisions. This approach works best in trending environments, not sideways or ranging markets. Keep practicing and reviewing your performance to continually improve. Now, let's head over to the next trading strategy. The second trading method also utilizes two different time frames and integrates the principles of buy-side and sell-side liquidity, liquidity sweeps, and fair value gaps as entry triggers. So, what do we mean by buy-side and sell-side liquidity? Liquidity that lies above a high or a group of highs is referred to as buy-side liquidity, while liquidity found below a low or series of lows is known as sell-side liquidity. So, what typically unfolds at these levels? Institutional participants, often called smart money, frequently aim for these liquidity zones. For instance, if smart money intends to purchase an asset, they'll need a large volume of sellers in the market to absorb their buy orders. So where do they locate those sellers? It's commonly known that when the price reaches a significant support area, many retail traders, and even institutions, will enter long positions. They usually place their stop losses, which are effectively sell orders, just beneath that zone. Smart money will intentionally drive the price down to capture that sell-side liquidity and trigger those stops. This action provides the selling volume necessary to execute their substantial buy orders. In addition, breaking through this area often entices new sellers into the market, assuming the price will continue to fall. However, in many cases, after smart money gathers that liquidity, the market quickly reverses upward. This move traps both the early long positions and the breakout short sellers. The same principle applies to buy-side liquidity but in reverse. If smart money aims to sell, they need sufficient buyers. They push price above a major resistance level to activate buy stop orders and attract breakout entries, then quickly reverse price downward after accumulating the liquidity they need. With that said, not all liquidity zones are created equal. Certain liquidity levels hold more weight than others. There are specific factors that can help you identify the more impactful liquidity zones. For instance, zones located near major swing highs and lows, higher time frame key levels, or areas with several equal highs or lows are generally more reliable. Now, the best part is that with the price action toolkit, these critical liquidity areas automatically appear on your chart, giving you a clear view of where institutional interest is most likely to be focused. This simplifies your trade planning by showing where smart money might strike next. Let's now walk through how this second trading strategy is executed on the chart. Start by activating the Price Action Toolkit, and in the Settings menu, enable the buy-side and sell-side liquidity zone features. Once turned on, you'll see these major zones clearly outlined on your chart. Next, wait for the price to move beyond one of these zones and then quickly return back inside the range. This behavior indicates a liquidity sweep or a false breakout, signaling that smart money has collected orders and is likely ready to drive price in the opposite direction. At this point, switch to your lower time frame and look for fair value gaps that form immediately after the sweep. These gaps highlight market imbalance and can serve as potential entry areas. In a bearish situation, for example, after a sweep above a buy-side liquidity zone, locate a fair value gap and signs of price reversal. Once you have confirmation, execute a short trade. Set your stop loss above the high that was swept and aim for the next major level or sell-side liquidity area below. The same logic applies in the opposite direction. In a bullish scenario, we focus on sell-side liquidity sitting beneath key lows, which the indicator marks for you. When price dips below that level and then closes back within the range, it suggests a bullish liquidity grab. Then move to the lower time frame and wait for the indicator to display a bullish fair value gap that emerges right after the sweep. This gap becomes your entry area. Open a long trade from there, place your stop loss under the low of the sweep, and aim for the next buy-side liquidity target. This clear process allows you to trade in alignment with smart money rather than fighting against it. Now, let's move forward to the third smart money trading strategy. This setup relies on a single time frame and integrates the concepts of equal highs and lows, liquidity sweeps, and once again, fair value gap entries. So, what exactly are equal highs and lows, and why do they matter so much? Equal highs and lows are specific price points where the market reacts multiple times without successfully breaking through. For example, when price tests the same high more than once and fails to push past it, equal highs are formed. These zones often become psychological hotspots where many retail traders place stop-loss orders just above the highs, expecting the price to reverse. Smart money traders, however, view these areas as liquidity pools, zones loaded with pending stop orders, making them attractive for price manipulation. When the market makes a sudden move to clear out these equal highs or lows, it's referred to as a liquidity sweep. This type of move usually signals that a reversal could be imminent, especially to the downside once equal highs are taken out. But what if a fair value gap appears just above those highs? That sets up an ideal trade scenario. The sweep pulls in the liquidity, and the fair value gap offers a strategic zone for entering a short position. To implement this setup on your chart, begin by turning on the Equal Highs and Lows feature within the Settings tab. The Price Action Toolkit effectively detects and marks these key levels automatically on the chart. By adjusting the ATR multiplier in the settings, the indicator becomes more sensitive, capturing a greater number of equal highs and lows by accounting for broader price movements. We also make sure the fair value gap feature is active and then wait for all criteria of the strategy to align. A high probability bullish setup is seen when price clears liquidity beneath equal lows and sits directly above a bullish fair value gap. Similarly, a high probability bearish setup appears when price takes out liquidity above equal highs and then hovers below a bearish fair value gap. That concludes this breakdown. Thank you for watching this video. I hope you found this video valuable and easy to follow. Now, I'd really appreciate a small favor. Just hit the like button and subscribe to the channel. It only takes a couple of clicks, but it truly makes a big difference. Thanks again for watching, and I'll catch you in the next one.